Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. House prices are bouncing back, recording the strongest monthly growth since November 2021. CoreLogic's National Home Value Index shows the pace of growth accelerating sharply during May to 1.2%. Now, that follows a rise of 0.6% in March and 0.5% in April. Let's break it down and find out which cities are leading the growth and which parts of the country are lagging behind. Tim Lawless is the head of research for CoreLogic. Tim, welcome back to Fear and Greed.
Many thanks. One of my favourites. Good to be here again.
Thank you. What is going on, particularly in the Sydney market? Wow. Who would have, did you expect this 3-6 months ago?
No, absolutely not. And it's a very strong rate of growth in Sydney, up 1.8% in 1 month alone. Yeah, and since that market bottomed out in January, we've now seen 4 months of growth. Values there are up about 4.8%. So if we want to look at sort of dollar value change here, just the last month alone, we've seen Sydney housing values increase a little bit more than $18,000. So, well and truly bouncing back. But of course, it comes after the market fell by nearly 14% through what was a very short but sharp downturn.
Okay, now we'll get to some of the reasons in a moment, but we might just go through some of the numbers. How about Melbourne? How's that going, that city?
Yeah, well, Melbourne's increasing pretty quickly as well, but on the monthly numbers, only at half the pace of Sydney, up 0.9%. And Melbourne's recorded 3 months consecutively now of values rising. So it's up 1.6% over the quarter. That's added nearly $12,000 to the typical price of a home. So, Melbourne definitely lagging a little bit behind. Sydney tends to lead the cycles, and that's certainly standing out once again through this current recovery trend.
What about the other capital cities? Any others sort of following the lead of Sydney and Melbourne at this point?
Well, pretty much everywhere. There wasn't a single capital city that didn't record a rise in value through May. But there are a few that are lagging the trend quite clearly. If you look at the rolling quarterly change, for example, it's still negative in Canberra, or roughly flat, down 0.1%. Darwin, which tends to be a lot more volatile, is down 1.3%, but mostly that's due to a fairly weak unit market. And then Hobart, down 0.5% as well over the rolling quarter. Then you can look at markets like Perth, and even though Perth values aren't rising as quickly as Sydney, they're up 2.4% the last 3 months, it's the only capital city that's recovered back to a new record high in May. Although, even though that sounds quite spectacular, it's still a very cheap market, which it just reflects that long-term downturn that Perth went through between about 2014 and 2020.
Okay, and then Brisbane, we better not forget Brisbane and Adelaide.
No, of course not. The performance in both those cities is still very positive, but the trajectory has been quite different. Adelaide's been a very resilient market through the rate hiking cycle. Values are up nearly 1% over the month and a bit more than 1% over the rolling quarter, but they're only, compared to where the market peaked, only down about 1.2% from the peak back in July. Whereas Brisbane looks like a stronger recovery trend, up nearly 2% over the past 3 months, but values there are still about 9.4% below where they peaked back in June last year.
Okay, and what about houses v apartments? Is it more noticeable in one area or the other?
Well, it is a little bit, and I know that's not a very good response, but at a broad level, it looks like houses are bouncing back a little bit faster than what units are in their recovery trend. So across the capital cities, house values up 3% the last quarter, the rolling quarter at least, and unit values up 2.3%. But there's quite a few examples where units are outperforming houses. Brisbane, for example, where the unit market's had a really long run of hardly any growth. In fact, values now are hardly any different to what they were 10 years ago. So unit markets showing a stronger return there, also a little bit more resilient in Canberra as well. And interestingly enough, similar to Brisbane, that's been a relatively subdued performer across the unit market because of a long-running overhang of supply, which now seems to have been absorbed. But most other markets seems to be a story more about houses bouncing back a little bit more quickly following a larger drop in house values through the downturn, where units were a little bit more resilient to price falls.
Stay with me, Tim. We'll be back in a minute. My guest this morning is Tim Lawless, Head of Research at CoreLogic. Now, during COVID, we heard lots of stories about people tree changes and sea changes and pushing up regional prices. Have they turned around yet? And when we talk about regional prices, Tim, you better explain it to us because, my hometown of Orange in New South Wales is very different to the Gold Coast, which is very different to Ballarat. So regionals is a great catch-all, really.
Yeah, absolutely. Regionals is pretty much anything outside of a capital city. And of course, the capital city boundary is defined by the ASGS set of boundaries from the ABS. I won't go into technical details, but essentially anything outside of the metro area would be considered regional. And there's definitely apples and oranges mixed in with that. As you say, like Orange, interestingly enough, I was just looking at the numbers for Orange before, and it's been a pretty strong market. Most of the agricultural markets around the country have really bucked this softer trend through the rate hiking cycle. They tend to be a lot more disconnected from the rate hiking cycle and more connected to their own local economic microcosm, be it agriculture or mining or tourism, whatever it tends to be. But we're definitely seeing some signs that regional markets are turning around. That they didn't see as deep a trough in the correction that we just had, but they're not seeing a recovery trend as pronounced as the capital cities either. So overall, about a 0.8% rise in regional markets over the past 3 months compared to a 2.8% lift in capital city values. And interestingly enough, you can look at a really good report that comes out of the Regional Australia Institute. It's pretty clear that that trend towards regional population growth is very different now. There's a lot more people leaving the regions to come back to the capital cities, as well as more people leaving the cities to go to the regions. So much more of a balanced internal migration flow.
Okay, so the two big questions. The first one's why, and the second's will it keep going? So let's start with the why. Why are we suddenly seeing this turnaround in the market when many market watchers, in fact, the consensus view was that the market would fall more than it has?
Yeah, it's fascinating. And normally when you look for a turning point in the market, you'd be looking for like a rate cut, or you'd be looking for credit to become more available, or maybe some sort of fiscal policy like the boost to the first home buyers grant. None of that's obviously happened. This turnaround in market conditions just simply comes back to really low supply levels running headlong into stronger demand. So if you look at supply, the best way I think to measure effective supply, at least, is just look at how many homes are available for sale. And across the capital cities, our listings data is tracking about 24% below the 5-year average for this time of the year, about 15% below last year as well. And it's trending lower still. It's not starting to pick up. So you've got listings about 24% below average, and you've got demonstrated demand, being the number of homes actually being purchased. Sure, it's down pretty sharply from the highs we saw back in 2021, but it's only fallen back to roughly around the 5-year average levels. So you've got roughly an average level of home buying activity against a really, really low level of supply, down about 24% on average. That's where this disconnect is. And for buyers, there's not a lot to choose from. So it looks like buyers are becoming increasingly competitive. We can see this in clearance rates holding up above 70% generally. Homes are selling faster, and vendors selling by private treaty aren't negotiating as much either. So whichever way you look at it, it looks like vendors have taken a little bit more leverage back at the negotiation table and are enjoying some pretty strong selling conditions.
So how does it play out? We know that new building approvals are down about, I think it was 24% earlier in the week. They came out from over the past few months. We obviously have higher interest rates. We had the Reserve Bank Governor, Philip Lowe, talking about the rental crisis and talking about, I think he said 15% of people could be underwater in terms of their free cash flow post-mortgage, etc. So much going on in the market. What's it mean for house prices? I get that in the short term, there's a supply issue, but at some point that will come on. Of course, I haven't mentioned migration either, Tim, so we better throw that one in. When you put all that into the mixing pot, what does the next year, 2, 3 years look like?
Yeah, I think the net result of what you just explained there is just a sheer level of uncertainty, to be honest.
Yeah.
I look at the numbers in front of me at the moment. Sydney up 1.8% in a month. I wouldn't describe that as being sustainable. You'd have to think that If we did see housing prices continuing to rise as quickly, I think it would probably be weighing on the RBA to lift rates, just out of fear of a re-establishment of the wealth effect and consumer spending holding higher for longer, which flies in the face of bringing inflation down. And obviously, the RBA doesn't target asset prices. They're pretty clear to explain that in the minutes from the last meeting. But they were pretty clear to point out also they're watching asset prices very carefully. So I think reading between the lines, higher housing prices could potentially be one factor influencing a decision to push rates higher, as well as the fact that inflation's looking pretty sticky as well on the monthly inflation indicator that came out earlier in the week. So, I think if interest rates do end up rising, you'd have to expect that's going to quell some of this exuberance that we've seen in the market. And even beyond that, we know that affordability is still fairly stretched across most markets as well.
Tim, great time to have your job, really.
It's quite the roller coaster ride, isn't it?
Yeah.
It's a good time to be alive.
Yeah, exactly. Tim, thank you very much for talking this morning to Fear and Greed.
Absolute pleasure. Thanks for the invitation.
That was Tim Lawless, Head of Research at CoreLogic. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.